You will be placed into the conference as a listen-only participant.
Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is David Blake with Tucci Tech Talk. And like every week, we're going to quickly review the last couple of days, try to figure out where the market's going. Then we're going to take a look at some of the different sectors. In particular, today we're going to look at, go over each sector. And I want to show you a place where you can find out the PEs of different industry groups that are in the individual sectors so that you can try to find some stock ideas in groups that aren't overbought or maybe beginning to deteriorate, and you're getting to them a little bit late. So we'll talk about 20 or 25 minutes. We'll go to a couple of different sites. We'll share the screen a little bit, give you a chance to ask some questions, and for the last 10 or 15 minutes, and then we'll open it up. Anyway, last week we were kind of in a summer doldrums. We had finally had a breakout last Friday in the S&P and NASDAQ, although I really wouldn't call the NASDAQ a breakout because it's been marching higher pretty steady. But summer doldrums, we refer to that when we kind of have low volume, low volatility. The daily trading range begins to narrow or tighten. And what we saw on Friday, where we actually had the big pop up, there's an old Wall Street adage that says never short a dull market, and that certainly was the case. If you were thinking that the market was going to roll over here last week, momentum was slowing. We didn't break down. We ended up breaking out the other way. So whenever you see that kind of trading, you really don't want to think of front run a breakout. And what we're going to look at right now, last week we finished the S&P 500 and the NASDAQ at all-time highs. The CTI as of this week is a bullish +3, and that's going to be reevaluated. The CTI doesn't flip bullish bearish on just at the turn of a cycle. There's other things that we weigh into it, such as the momentum and sentiment indicators, and we won't know whether we're going to flip to a bearish signal this Friday or not. At this stage, I'm kind of leaning forward. It will probably extend the bullish cycle another week or two. We'll weigh that. What would change my mind would be if we would take out the lows from, I believe it was a Tuesday, right over here. If we would take out that in the major indexes, I could flip it. But we'll have to wait to see maybe Thursday or Friday, to read the weekly market letter on Friday to see what we're going to do. The momentum index right now is a neutral +3. You had this real slowing down the momentum, which really hurt the momentum index. Internal breadth was marginally positive last week. However, we did have the NYSE AD line, which is the advanced decline line, making an all-time high, actually even yesterday. And the NASDAQ AD line is also breaking out to new highs for it. So that's a positive for this market. The momentum may be picking up on this little bit of a breakout. Sentiment index is also neutral. However, some of the indicators that we follow, such as the bullish investment advisors, which was last week was at 52.9, is close to getting bearish, and also as far as the bearish advisors, we're down to 21.2, so that's almost a bearish signal on that. We did have the fear and greed index come in last week at 78, so that is bearish. People are getting a little bit too rambunctious on that end. But first, let's look at the different indexes real quick. See we see anything that's bringing up a red flag, and then we're going to go over these sectors to see where and how we can find out some trading ideas, so we're not buying overextended areas of the market or areas of the market that begin to slow down and deteriorate. Okay, you saw last week the Dow Jones hasn't quite broken out. I think today we're up about 50 points, so we're getting close to that breakout range where we can get close to a new high. We are seeing some negative divergence in here, but I'm not. This isn't quite the red flag that normally would be, mainly because this slowing the momentum that we had in the Dow really took its toll on the 14-day RSI. The MACD is still bullish, but it has narrowed. we'll probably see an expansion of that coming out here. But if we would start to see this thing break down, the 50-day moving average is in here around just above 18,000, and maybe 1875 or so. So this, between that and last Tuesday's low, which was around 18,247, that would be an area that if we would start to see some selling from some global events or whatever, if it would break through that area, it would definitely probably indicate that we're going to have a little bit of a correction. And that 18,050 or so would represent a 38.2% retracement of this move up from the Brexit vote up. So that area you want to keep an eye on. At this stage, I think we're fine. 30-day stochastic shows that we're still bullish on that too. Here's the AD line that we talked about. Accumulation remains strong. We also, as far as the new 52-week highs and lows, we're still seeing expansion in that. Yesterday we had we slowed down about a week and a half ago. We were only picking up 97, 98 new highs, but we're back. Yesterday we had 316. Today we're back above 300 some again, so that's bullish for the trend going forward. Here's the S&P 500. You can see this little bit of a breakout here. I do see this is a bit of a red flag over here. Even though momentum was waning through here, you'd like to see this 14-day RSI start to get back up here around 70 to confirm that this is the momentum is going to start picking up again. Now, one thing I wanted to point out with this thing, when you see a breakout like this, and let's just say that this thing goes today and then also we start to break down, technically you want to note that is called a bull trap. I don't think it's going to be a bull trap. I think we're going to work our way higher here. A bull trap, though, is where you get a breakout, the indicators don't confirm it, and then all of a sudden you break it out, and what happens is you get a bunch of shorts going in here, they cover themselves, new buyers come in, buy the breakout, and then the market rolls over and everybody just went long, is stuck holding, kind of holding the bag. But like I say, I don't think that's going to be a bull trap. I think this is going to continue to work our way higher for another week or two, and that's why my inclination is that the CTI will remain bullish for a little while. We'll extend the cycles a little bit. Okay, here's the NASDAQ. I wouldn't call this a breakout, really. We only consolidated about 2 days. It continues to march higher. We're higher again today by making another new high. We're up about almost a half a percentage point here. I'm not worried about this little divergence. That was just a little bit of a slowing momentum. The MACD again is expanding. That shows that the trend is strong, and it looks like that's the long term. So this is probably going out another week or two at least. The NASDAQ should be able to work its way higher. Here's the AD line on the NASDAQ showing good accumulation. And we're also up here. Yesterday we had 199 new 52-week highs on the NASDAQ. And for the NASDAQ, that's good. The last time we had that many was back in mid, back in early July. So you are seeing some expansion in the new highs, number of new highs too, and that's good. Okay, just also it's confirming the move, the NASDAQ. I wanted to show you the Philadelphia Semiconductor Index. Again, we had a breakout here to new highs. We had the slowing of the momentum, came down here to this gap area. It did not fill the whole gap, which is bullish, and started up again. Here we're getting some more gaps breaking away. We're up again today. That's confirming the move by the NASDAQ, that the semiconductors are participating. And here is the iShares NASDAQ Biotech ETF, IBB. You can see we broke out this double top over here, and we also broke above the 200-day moving average, and also we broke above a descending trend line, which is bullish. And the next chart here that we want to look at, this is going back to the 2008 with the biotechs, and you can see that this pullback here the last 2 years basically retraced about 50% of this move from back then. We basically had at about a triple bottom, which looks good. The RSI looks strong in here. The 30-day stochastic is up, and now we've broken back above that 38.2% retracement level here. And usually when that happens, you can probably get we're around 300 on this right now. I would look for, on a strong market, we could probably get back up to around 340 on that. I think, I like the biotechs. I like them. I think that's an area that you want to be buying shares in here. Right now we're right around 295. So again, I think if we looked at the point and figure charts on that, we could probably see a little bit more expansion, get a better target on that. Okay, the next one I want to look at on the indexes before we get to the sectors is the Dow Jones Transports. We always come back to this, and this seems to be the thorn on the rose. We're down again. Every other index is up again. The transports are down just barely today, but they cannot break out of this 8100, 8150 area, which is where we need it to go to break out the new highs. Now, one thing on the chart you can look at, you can see this shoulder pattern here. We see a head here. Maybe we see another shoulder pattern here. So if we can get a strong day here with takes us up, 8175, 8200 on the Dow Jones Transports, you would get yourself a reverse head and shoulders breakout, which could have this thing run back up to about 8900, and that would be extremely bullish for the overall market. Now we showed some figures on the point and figure breakouts last week on if the Dow Jones has another big breakout day here coming up soon, the upside target is somewhere around 19.3. So if you see the transports really take off, this market could have a big move up, which is going to catch everybody by surprise. We'll have to see if that happens or not, but there are signs that we could have a real bust out in this thing. But you see down here the 30-day stochastic is trying to get back up above 80, which I like, but we still see the negative divergence in the 14-day RSI, and the MACD long term is it just can't get ahead of itself. It's kind of going flat, so that's kind of negative divergence. It's not telling me that we're going to get a breakout in this yet. So we'll have to keep our eyes on the Dow Jones Transports to see if it's going to finally confirm a higher move in the broader market. Okay, now what I want to try to do is I'm going to put up a chart, a page here that I hope you'll look at. I got to find it. Okay, take a look at. I want you to write down this URL. This will take you to the Ardeni research site, and they have a weekly or biweekly. They're going to put up what they do is they look at all the sectors, and then they kind of break down the sectors to different groupings, industry groups. And then what they do is they'll put up the PE and they'll put charts up of the different industry groups in those sectors, and it will show you historically where these sectors or where these industries groups should be trading. I think this is something that when you're looking for good ideas, if you go to this, it's free. You get it a couple of days after their institutional clients get to it, but it will help you find out, again, ideas that we are not chasing chasing stocks in industry groups and that type of thing. I think this would really help you finding some ideas and what sections are overpriced or undervalued and that type of thing. So if we look at first off the consumer discretionary sector, the symbol on this is XLY. It's kind of interesting. We broke out this up into the new highs. It's been kind of going sideways over here. We have some negative divergence in the 14-day RSI. MACD is still bullish but close to rolling over. We've come to this level 1, 2, 3, 4, 5, 6, 6 or 7 times. So I think once we break through that area, again, that could signal that this market is poised to really take off. Now today we're at 47.20. Wrong one. Today we're up 8 cents, so it's still banging its head up against this area. But you'll kind of want to watch that thing. Now historically, the PE right now on the XLY, we're trading at a PE of about 18, 19 times earnings. That's kind of in line with the historical PEs. But if you go into if you break down this sector into different industry groups, you'll find like auto manufacturing, and some of these PEs I got from the Ardeni site are trading at 7 times earnings. Auto parts, are at 10 times earnings. You look at casinos, they're at 24 times earnings, so that's an expensive group in that sector. You also look at restaurants, they're at 24, 25 times earnings, expensive. Footwear is at 23 times earnings, but if you go to the Market Edge Industry Group analysis, you'll see that footwear is beginning to deteriorate, so that's when it will scratch off our list. Okay, you got home building stocks right now are trading at around 13 or 14 times earnings. We'll look at some different stocks in that. That's still a improving group in our sector. Home improvement stocks trading at about 20 times earnings. That is in line historically. So if you look at that, that's going to go back to our industry group. You're going to auto parts are deteriorating, and also footwear is deteriorating. So you'll eliminate those two sections, but then you'll look at the other PEs in this consumer discretionary sector, and you'll be able to find some different stocks in that. Okay, you look at the financial sector. It's trading right now at about 14 times earnings. It's not my favorite. We do have, you can see over here, negative divergence. In fact, where we were going sideways here, and when we break out, we're not up to the other peaks over here. So the financials, I think, are improving. They are underperforming the other sectors at this point. Although the power rating on our Market Edge power rating is bringing it up where it's about the 6th most powerful sector right now, or mainly because of the last week or so. I think what you're doing in here is you're starting to see with some of the stronger economic data, people are seeing that the interest rates aren't going to go any lower probably in the States, and if that's truly the case, then it may be slow. It may be a slow, gradual climb. But you could start to pick up some of the bank stocks. You're not in a big hurry. I might even just pick up partial positions in some of the stocks that I like, the J.P. Morgans or something like that, or maybe some of the regionals, and then just watch the market because there's still the chance that we could get some kind of little knockdown here just going into the election. So you nibble away at the financial sector. I think you'll be good on the longer run. The next one we look at, and again with the financial sector, if you go to the Yardeni site, what you'll find in there, they're going to look at asset management. They're trading at about 14 times earnings. The big diversified banks are cheap. They're trading at about 10 or 11 times earnings. You have the brokerage firms are trading 12, 13 times. So all those still have low PEs. The insurance companies are getting a little bit more expensive, the Prudentials and the Aetnas and stuff like that. Life and health companies are trading about 9 times earnings. They're cheap. Property and casualty are trading about 14 times earnings. And again, then you take that and go over to the Market Edge industry group, and you'll find some stocks that are into some of the cheaper PEs of that. Here's utilities. Utilities are trading right now at about 18, 19 times earnings. Historically, they trade at around 9 or 10, so you're very overpriced on the utilities. You're also beginning to see the breaking down of your technical indicators. I told you the last couple of weeks that if I owned utilities, I would be holding in here just because of the yields. But I think now that you're starting to get hints and there's a 10-year and stuff that the rates are starting to move up a little bit. Now you're starting to see this breakdown. Here's an upward trend line that breaks through that area, and you see XLU start to break below this 50 and break below the 100-day moving average, especially. Then you probably want to start lightening up. But the indicators are already showing you that we're getting a lot of distribution. You can also, if you get in your smart charts, look up the 50-day up-down slope or ratio, and you can see the distribution, and it's starting to happen over here. So at this stage, I think unless you're 65, 70 years old, you still want the dividends. If you're younger, you may start to clear out some of your utility stocks. In fact, electric, gas, and water are all trading. Gas is at 22 times earnings, electric's at 18, 19, and they all are in the Market Edge industry group are all deteriorating at this stage. So now you can begin to, I think, start to lighten up on the utilities, and they are they're up a little bit today with the broader market. Okay, now we have the tech sector, which I like. The tech sector, believe it or not, is still cheap. With tech right now, I think we're trading about 17 or 18 times earnings. On a bull market, that can get up to around 21, 22 times earnings. So considering what the overall market's done, technology stocks, I believe, are still fairly a good bargain in here. As far as some of the different industry groups over there, you can look at semiconductors. Now they're a little pricey. They're getting up here around 30 times earnings, which is a little bit high. But your data processing is around 22 times earnings. Actually, I take that back. Semis are around 16. Software was around 30 into 30. So the software technology stocks are a little bit pricey. The semis are only around 16, 17 times earnings. Semi equipment is around 15, and data storage is trading around 12. So those are some areas in technology that are still undervalued, that haven't taken off yet, that you might be able to pick up some ideas. I don't see that this isn't really worth much of a divergence in that. 30-day stochastic is still strong, and the MACD is still expanding, so that looks good. Okay, here's the healthcare. I still like healthcare. Healthcare is trading right around 15, 16 times earnings. That's below the broader markets, but maybe a little bit cheaper than that now with the drug stocks yesterday kind of blowing up. But in there you can look at the biotechs. The biotechs are trading, they're cheap. They're trading around 13, 14 times earnings, which is below the sector average and below historically what they have. As you saw, we traced about 50% of about a 6-year move or 8-year move. So the biotechs can be bought in here. Health equipment's trading around 20 times earnings, so that's getting a little bit pricey. Managed healthcare is 16 times earnings, not bad. Hospitals, 13. Pharmaceuticals trading about 15, 16. That's relatively in line where they trade historically, even with this pullback. So they are their pullback in the last couple of days here may be a little bit overdone. That may be an area that you could probably go back to work on some of these big pharmaceuticals. I think that the pullback that we've had there is overdone. Okay, here's materials. Materials are trading somewhere around 18, 19 times earnings. A little bit pricey historically. Historically they trade around, they're around 16 times earnings historically. But the materials, you can look at aluminum. It's trading at around 20 times earnings. That's expensive. Paper products are around 10 times earnings, undervalued. Steel's at 18. That's getting pricey for steel. Usually around 12 or 13 is about historical P's on that. Chemicals are about 16 times earnings, kind of in line. Specialty chemicals at 21. They do have a little bit of a premium, but they're starting to get a little bit pricey. And I'm starting to see a little bit of negative divergence over here in materials. Tells me that they may be going sideways at this stage. Okay, the energy. Energy is trading right now at about a 40 times earnings. If on some PEs, if you look at forward PEs, it'll go down. Trailing PE, it doesn't even have a PE on it. But you can see over here on the energy sector, you look at integrated oil, it's trading around 28 times earnings, but that also is showing deterioration in the market edge industry group. You have drilling. There's no PE really on that. It's deteriorating. Pipelines are deteriorating. Exploration and productivity, you don't have much of a PE on that. Oil equipment is trading around 45 times earnings, but the refiners are trading around 13 times earnings right now. If you want to get involved in the energy sector and look for a segment of that sector that's not overpriced, I would probably be more inclined to look at the refiners. Maybe I don't have an idea. We'll go look at that later on when we go to the industry group analysis. The next one over here is the industrials. Again, a lot of negative divergence in this, which kind of bothers me. You're also getting close to getting a sell sign on the MACD long term. So I have a little bit of questioners on this. But the XLI, the PE on this is around 17 or 18, so it's trading in line with the market. Historically, I think it trades. It's kind of at its historic PE right now. It trades around 17, 16, 17 or so. It's not overpriced on the industrials. But you look at that. You look at machinery. It's trading at around 20 times earnings. The conglomerates around 20. Aerospace and defense is cheap. at around 17 times earnings. You have your Boeings and Teledyne stuff, but that is beginning to start to show some deterioration in that industry. The electrical firms are around 18, electrical equipment's 22. Pollution is up around 20, 24, 25. That's beginning to show some signs of deterioration too. So again, when we go to the Market Edge site, we're going to look at some of these industry groups that are broken down in this group. Okay, next one I want to show you. Okay, this is where if you go, after you check out the Yardeni research site, you look at that PDF, and you can see where some of the where you think you have an idea where some of the cheap groups may be, cheap industries may be, according to their fundamental, the PE. If you go into the Advanced Tools, click on Industry Group Analysis, then click on Condition over here at the top, it'll list these things from strong to improving to deteriorating to weak. So first off, what we can do, and we've talked about some of the different PEs on these different sectors, okay, we can eliminate looking right now for integrated oil field majors. We can eliminate some of the drug-based retailers, footwear, toys, tobacco, oil field drilling, beverages. Here's the utilities, electric and water utilities, pipelines. These are areas where we don't want to go into to start looking for ideas. These industry groups are in, you look at the sector, whether they're strong or weak, but these industries in those sectors are underperforming. And right now, as far as what we look at our power ratings, our sectors, energy, consumer staples, and utilities are not the areas where we want to participate, especially if the market starts to get its momentum back and start heading higher. Because at this rate, the PEs on those groups, you're gonna get a lot of profit taking as the market moves higher in those areas. So that's not where we're looking for new buys. If we click over here now in industry group again, and we click on relative strength, this will show you over the last 50 days which industry groups are outperforming the broader market. As you can see over here, we have precious metals and coal. This is in the materials section, steel. Then you get down here, semiconductors. Here's some of the retail apparels, paper products. We mentioned that in where was it? In materials, paper products are trading around 10 times earnings. We've got a strong, it's rated strong by Market Edge, and it's outperforming the broader market by 7%. So that would be an area where we can go in and find some ideas for stocks that are starting to really take off. And then also down here, most everything's rated strong because the market had that big move off of Brexit. But sometimes you'll find some of the improving industry groups that are starting to outperform the broader market also. That would be some ideas. But over here, like you see the pipelines, they've had a good run. They were outperforming the market by about 4%, but they're starting to roll over. Here's water utilities, had a nice run, still outperforming the market a little bit by 2%, starting to break down. Oil field drilling, starting to break down. Gas companies starting to break down, and they're falling down the line. Okay, what I'm going to do right now is I'm going to go try to change this so that we can change, we can share the screen on and pull up the charts and go to some of these sections, and we'll look to see if you have some ideas of what you want to look at as far as, some of these industry groups in the sectors. First, we had a question, do you like Pfizer or Bristol Myers? I do now, because everything is pulled back. I think you're going to see, I think it was a little bit overdone. They kind of all pulled down. Bristol Myers especially is probably overdone. You probably start to nibble away, but when you see these things have a big tumble like that, I don't always go in and just buy blindly, if I want to buy 200 shares of Bristol Myers, I may buy 100 now and give it a week or so to make sure that we've started to put in a little bit of a bottom, or maybe give a retest to the bottom, then buy another pair. You don't have to buy everything all at one time. This market's not going to get away from you at this point, I don't think. What do you consider the main leading indicators? Anissa Laporte said that. Anissa, if you could make that a little bit more succinct as far as the broader market, or if you're looking at different stocks or industry groups or whatever, that would be a help. Okay, I want to close this thing down now and pull up my smart chart, and we'll take some more questions, and we're going to look at this. Go to some of the industry groups and show you how you can start this. finding some stock ideas. See that, Will? Okay. All right. So now I'm going to go over to Market Edge here. And again, we went back to XLY, and we looked at when you go over here, it's one of the main sectors, one of the strongest groups. We go to Advanced Tools, click on all groups, and we wanted to go in here. Okay, let's look at XLV. We had that. We looked at the some of the different industries in there, the biotechs, medical equipment, hospital care, pharmaceuticals, and stuff. Okay, we looked at pharmaceuticals. Page 2. Go over here and click on pharmaceuticals. It's going to bring up some of the stocks over here. Now, a lot of these we still have. Bristol Myers, is getting ready to get downgraded over here. But if you go to that, you can also look at this Horizon. Click on Horizon. It'll pull up the second opinion. Look at the chart real quick. Coming off of a nice rounding bottom over here, starting to break out. I may want to go also look at the point and figure chart on this thing. And as you can see right over here, we just broke out of a double top breakout on this Horizon Pharmaceuticals. Looks good. Your first term, if it breaks through 24, you're probably going to get a nice move on that, because that's the first resistance over here. You have a spread triple top breakout, which could give you a run on that thing up to about $30. So this would give you an idea where you find a sector that's strong, like technology or healthcare. This is where you're going to find your stock ideas. So now we go back to another one in that group. Let's look at the biotechs. Medical and biotechs. Okay, so we pull off out of here. Here's the chart, which is pretty much the same as the IBB chart that we looked over that. Okay, so now we're going to kind of list things, strongest to weakest. This is kind of a joke. This Exact Sciences been showing up. You look at this chart. This is probably one you may want to pass on in here. That's quite a move from 6 to 20, but that's been showing up as one of the top biotech stocks to buy in here for quite a while. But you come back here. Let's take a look at maybe this Puma Biotech. You can go in here, look at the quick chart. It's not able to get through this 50-day or 200-day moving average, so we'll pass on that for right now. Here's Bluebird. It's a pretty big company. We can go over that, look at the quick chart. We're going to get another nice rounding bottom in here. It did break through the 200-day. We look at the point figure chart also. We can see that, we're still struggling a little bit on this thing. You may want to see this get up to around 60 before it's out of the woodwork. But it is in an upward trend at this point, but we're not breaking out. So you may want to pass on that one at this point. You can come down here. I'm trying to see something I'm familiar with. Here's that's too short. Pathina. Again, you can go in here, look at the quick chart. Okay, it's starting to break out over here. This is kind of an interesting chart. Go to the point and figure. We just had a double break on that over here at $58. This is one you probably want to look at as an option. And again, okay, so we look at the biotechs. They're trading around 13 times earnings. You can check to see some of these, what their PE is. Of course, a lot of biotechs aren't making any money, but you can look on that and just to make sure that you are in an undervalued industry and you're in a strong sector. Another one we can look at, if you go into the industry groups, and we go, let's say, to technology. The technology, when we looked at that, okay, we go to semiconductors. Semiconductors and related. Okay, this is going to give us, you can see the chart over here where it's breaking out. Here's versus S&P. If you've been following Advanced Micro, it's gone from about $2 to $7 recently. That's when you can look at it. We talked about Ambarella last week. You click on that. According to this, it's undervalued. Had a big pullback, nice rounding bottoms, starting to work its way higher. Had a nice golden cross over there. Look at the point and figure chart, which I don't think we looked at it last week. Again, here you had a breakout over here, a little bit of a pullback. This thing trades above 60. You're going to get another X on there. You're going to have a double top breakout. this amberella. So that's one that you, the semiconductors that you may want to look at. Here's linear technology. Just below that, we have a buy on it, upgraded at 47 a while back. The quick chart show, well, that we may want to pass on. Micron. Go over here. We'll take a look at the quick chart on that. Okay, we're starting to work our way higher. Got a little bit of a golden cross over there. Point and figure chart shows a double top breakout over here at 1450. This can probably get a trade in this thing up to around 1750. So that's a good idea. Again, we said that we looked at the XLK. It's underpriced historically. Semis are trading around 16 times earnings. That's cheap. Data storage is around 12 times. Semi-equipment is 15. I think the semi-equipment is going to be over here. You'll still find that in semiconductors and related. So that may be where you'll find some ideas in that. Going back over there, do we have a data storage? No, we have diversified technology, which would also, again, is breaking out over here. So you want to find some strong stocks in that. I'm not sure what these are. Here's Holly. I looked at that a while back. It had a good chart. Okay, coming off of this, a lot of volatility in this thing, but looks like it's breaking higher. The point and figure chart shows had a double top over here. So you get a trade up here at 22. If it breaks through that, you could get a run back up here towards the old highs. So again, that gives you some places by using our industry group analysis, and also using it, your identity to find which industries in those sectors are cheap. They give you some more ideas. Let me go back and see if we have some other ideas. Any more questions coming in? Okay, and this is on the broader market. Yeah, and this is one of the things you can look at. We look at the NYSE and the NASDAQ advanced decline line, and also the new 52-week highs and lows. And on that, if you go to the Market Edge homepage, one of the neatest things we have on here is free, is go to Market at a Glance. And this is going to give you all the, just a quick little chart of all the different industries. But down here, some really good information. Here's the NYSE advanced decline. That's bullish. Here's the NASDAQ advanced decline breaking out. Here's a new high and new lows on both the NASDAQ and New York. And you want to see this expansion in here as we're making new highs. That's what you're seeing. A little bit lagging a little bit right there. Yesterday we're up around 300. So this is, we're up to 300 today. So that's expanding. Here's market volatility coming down. We talked a little bit. We'll talk about some volatility in here again. But here's the weekly bullish advisors. Gets above 55. That's bearish for the market. It means everybody's too bullish. The weekly bearish advisors, that breaks down here below 20. That's bearish also, because that means everybody's too bullish too. Then you'll also see equity mutual fund flows. Amazingly, this thing for the last, if you've had like one positive week out of like 16 weeks in a row, people pulling money out of some of the equity funds. And also, you're seeing a decline in margin debt. Whenever you see the margin debt breaking out to new highs, it's a little bit of a red flag. But those are some of the leading indicators, and this is that we look at as far as some ideas. Okay, any other questions? I've gone a little bit longer than I meant to go. I hope you got some ideas of that from today, just where you can look at this market. Again, if we get another day where we pop up here, 15, 20 points, we're gonna have all new targets on the indexes. We had 18,650 on the Dow, which we already hit. We had 2,200 on the S&P, which we're close to, and we had what was it, 5250 some on the NASDAQ, which we already hit that too. So we will have some more targets to go. And again, if you see this thing really break out on one of these days, on some economic data or something, you could get a heck of a move. I don't think that's going to happen. I think we're going to, kind of churn a little bit higher in here, and then maybe start to roll over in another week or two, just because I think you need to be a little bit more cautious going into some of these, into the election. That's all I have. All right, so that's going to be it today. I hope you got something out of that. If you have any questions on what we talked about during this thing, please send an email to the doc@marketedge.com or support@marketedge.com. and I'll try to get to them later on. And I really appreciate you spending time with me today. I hope you got something out of that. Thanks a lot. This recording will be up on the site in about another hour or so.